Hello, hello, hello. Hello to new viewers and friends of new viewers. Today we have a very interesting topic. Today we're going to be talking about mortgage funds in an ever-changing real estate climate, excuse me. We have a great speaker today who's got tons of knowledge and will be able to help us kind of get a better understanding of exactly how the mortgages are going to be working from here on out in our IRAs. So what is an IRA? An IRA is an IRA is an IRA. It is an individual retirement account, and NuView allows you to self-direct those. So that is a marketing term, just letting you know that you have the power to drive the car with your real estate investments into whatever you're interested in, as long as it fits within our ability here at NuView to invest. The main benefits of an IRA here at NuView are going to be diversification. You can step outside of the normal stock, bonds, and mutual funds and invest into things, be it real estate, cryptocurrency, precious metals, and the list goes on. The main benefit is going to be the tax savings that you can experience, because an IRA is a tax sheltered vehicle allowing you to experience growth, and so you can receive your benefit upon retirement. And it allows you to invest in things that you are knowledgeable in. So if you're already invested into real estate or any other industry, it gives you the ability to make money now as a person and also save for the future using your IRA. We have 7 types of plans here at NuView. We have personal plans, which are going to be Roth and traditional. These plans are available to anybody that has earned income and has a social. The next group are going to be our employer plans, which is the solo 401k, SEP IRA, and simple IRA. These are these are geared toward people who have some type of self-employed income. And we have specialty accounts. So these accounts are dedicated more toward today. So health savings accounts, we all have some type of health requirements, whether it be dental, medical, vision. It can be used for all of those things. And we also have an education savings account, and this is going to be geared toward education for your children, not necessarily just your children. Maybe you have nieces, nephews, somebody out there who you spend money on educational things. It's a great way for you to get tax deductions and get tax-free distributions on your purchases. With all of those 7 accounts, you have the ability to invest in multiple avenues, one being real estate, promissory notes, private entities, cryptocurrency, the list goes on. IRS doesn't tell us what we can invest in, they just say what we can't invest in, and that's going to be life insurance contracts and collectibles. Outside of that, if you can put a title to it, 9 times out of 10, you can invest in it in your IRA. NuView is a passive custodian. So what that means is that we don't actually sell anything here. We just give you the ability to invest in things that you might already know. We can't exactly give you any advice, but we can put you on your path to success, answer any questions you may have, and work together to get you to where you want to be. And we give you the platform to find individuals that can educate you on whatever you're interested in. And today we're providing an individual that has plenty of knowledge on the mortgages and the real estate industry. And brings me to my next slide. We have Todd Piggott in today. So
hey,
thank
you. Thank you, Bill, for that introduction. I greatly appreciate that. And so thank you for inviting me today to speak on mortgage funds and the current state of the housing market and where we are likely to go from here today forward. So we have a lot of analytics that we study here at Zinc Income Fund on current housing trends and where housing is going across the nation. So a little bit about me. Went to Fresno State, graduated with a degree in construction as well as real estate finance, graduated with honors there. Previously, I had run a facilities maintenance company, had about 500 employees in that. Over the last 20 years, I've been running the Zinc Income Fund. I'm sorry, Zinc Financial and the Zinc Income Fund. We're a mortgage fund located here in Fresno, California. We operate across the nation. Our fund specializes in secured lending on distressed housing that investors purchase with the intent on rehabilitating those and then reselling them on the open market. So we have a very, very stable track record in this space. We've done nearly $1 billion of lending in the distressed housing market, distressed asset lending. And it's been very, very stable. Our investors realize returns of between 8 and 10% in this secure investment field. So we focus on distressed housing. So naturally, we spend a tremendous amount of time here studying analytics, portfolio analysis that tells us where the housing market is and where the housing market is going. Obviously, as a private money lender with a lot of investors that trust us, having this information on housing trends, where they're at and where they're going is very important for us so that we can better equip ourselves to manage that risk. So with that said, I'd like to introduce you to some current housing trends and some metrics that we follow here at Zinc. Nationally speaking, the trend for housing is, believe it or not, very strong right now, although there are signs that we are heading into a slight depreciation or a slight housing decline. The metrics that we pull are metrics from the federal government as well as the National Association of Realtors, and we follow these trends and map them here at Zinc so that we can better eloquently protect ourselves. Right now, the housing market is still relatively strong, although there are signs right now, as of January and February and March, that we are in decreasing activity, decreasing velocity. For the most part, we're still in a very, very strong market right now. This slide here talks about the national existing home sales. Right now, we're at a rate of about 6.5 million. That is still above average over historical terms. Housing is moving at a very, very solid clip right now. Again, although showing some signs of decreasing, for the most part, we're still in a very solid housing trend right now. I do expect this to mitigate and head downwards as interest rates begin to escalate and climb. We are expecting those over the next 12 months. The median price of housing, I think this is an important metric that we watch very carefully. Nationwide, we're at the highest point in history at about $350,000. I think we were at $348 just a little bit ago. Housing has appreciated pretty substantially over the last 7 to 8 years. We are now at an all-time high for the median cost of housing. Median is defined as 50% below and 50% above that number. So at $350,000 on a national level, what that is telling us is that 50% of the houses sold below that number and 50% of the houses sold above that number. Here on the West Coast, which is where we're located in California or some of the regional areas of, maybe Texas and Arizona, in California, our median cost, believe it or not, is $750,000. So the median cost of housing is very high right now. I don't expect it to decline any significant number because of the shortage of housing out there and the low inventory. This is an important graph for us to understand here. Total existing home sales year over year is starting to decline. I actually view this as a positive change. Why? The appreciation that we were on at 10 and 12% year over year was simply unsustainable. That type of appreciation is not fluid for the secondary market buying houses or the affordability index. At the bottom line is housing could not continue at that pace. I am happy after $1 billion of lending in this space, I am happy that we have some relief and that housing is starting to somewhat subside a little bit. We cannot continue to go at the appreciation pace that we have. Over the last 75 years, housing has appreciated approximately at the Consumer Price Index or the CPI index, 2.5%, 3.5% a year. Over the last several years, we've been in the 5, 10, and 12 range. It's simply unsustainable. This graph will show you that in August, September, October, December through January, we're actually starting to see declines of existing home sales. I think this is a positive trend that we're getting down to more normalcy for housing movement and housing velocity. That's just a quick little pie chart we put together. Housing across the nation is relatively moving at a fair clip, regardless of geographical territory. The South is very, very fluid right now, as well as the West Coast. We do have some up in the Northeast that's showing some signs of regression, but for the most part across the country, it is still relatively stable. Sales price by range. Prices above $1 million are seeing the most regressionary trends right now. Those housings are seeing the fastest velocity of subsiding a little bit. Houses above the median or around the median range are still moving at a relatively fast clip. Here at Zinc Income Fund, we focus on distressed housing for our investors that's below the median cost of housing. In other words, we make loans to real estate investors that buy distressed properties with the intent of rehabbing them and then reselling them for a profit. We charge our borrowers about 9.5%, and about 8% of that goes to our investors in our fund. But we focus below the median cost of housing because that is the safest territory to be in from a risk perspective. Prices above $1 million are quickly to show the most stress, which is what we're seeing now. But median cost of housing and below, which is considered entry level, is something that I tend to focus on here at Zinc Income Fund, because that asset class or alternative asset class is the least likely to be affected. At the end of the day, people still need entry level homes. This graph tends to dictate the sales volume or sales velocity by asset class. You'll notice there that the 100 to 250 or the 250 to 500, which is approximately the median and below, represents the largest portion of this pie graph. Pending home sales. This is from January. We're still relatively strong. Again, we are seeing some signs over the last 60 to 90 days. This is not out in the public yet. We are seeing some signs that we are beginning to level off or even in some cases depreciate on velocity. However, inventory is so slow, so contrite right now that we are still seeing a very strong, strong movement, at least until that inventory begins to pick up. Here we've got the Midwest and Northeast, very strong absorption rates, as well as the West and South. For the most part, this graph is indicating that housing is very strong. Again, albeit showing some signs of stress already, but for the most part, we're safe haven right now. I think this is an important metric to look at. We put this together for you. Who buys these homes? Home volume out there is very strong right now. Who buys these? Well, first-time borrowers, or first-time buyers rather, represent about a third of all transactions, and they're in their early 30s, maybe even late 20s. The average median of a repeat borrower is in their 50s, and the average for income is around just below 100,000 for a first-time buyer and just above 100,000 for a repeat borrower. I think the next thing is very important here. The typical home is around 2,000 square feet and approximately 20 years old. This is also the type of asset class that Zinc Income Fund focuses on. We focused on used housing below the median cost of housing that can be picked up by a first-time home buyer. That's where we tend to place our funds, because that is obviously, as this graph shows you, that is the most likely group to be picking up that type of asset. This is very important here. Those who finance their homes typically financed 87%. I think it's an important concept here. Our housing today is mostly, almost exclusively, federally backed loans. These people are fully qualified, fully amortized, 30-year government-backed loans with between 3 and 10% down. Why I share this information with you is that previously, back in the 05 to 07 crash, we did not have these types of loans. The loans that were back in that period were option arm loans, or interest-only loans, or even negative amortization loans. Those loans were very susceptible to default. I was in this business during that period. The average person that went into default actually owed more on their house than what it was worth, and the average person in foreclosure at the auction steps had refinanced their house approximately 8 times. The loan product back then is much different than the loan product we have today. The loan product we have today over the last decade is 30-year amortized government-backed loans that have equity in them with full documentation of the borrower. So my projection is, even though housing is starting to dissipate a little bit, we are not headed for the crash that we had back in the 05 and 08. That was profoundly through collateralized debt obligations on Wall Street that bought these loans that people otherwise could not afford to be in. Negative AM and option arm loans was a bad product, and people simply owed more than the house was worth, and then they began to default. Today, and I'm going to talk about this a little bit later in my slideshow, today these loans are performing. They have equity, they have full documentation and full income to be able to sustain that mortgage payment, and they put cash down. So if we do head into a slight housing bump here, I do not believe that it will be the cliff that we had in the earlier periods back in the 05 through 06. Okay, so a little bit of here about California real estate, or the West Coast. You'll see here some red here. That's right. We do have, as I told you, some velocity of existing homes is down 10% year over year. The existing home price right now in California is about $750,000. So even though the housing velocity is slowing, this is very important. If you look at this graph, the median days on market is still at 12 days. Our unsold inventory out here is still at about 1 to 2 months. That is unsustainably low. The more of an average days on market would be 60 to 90, and unsold inventory would be maybe about 6 months. Right now, we have a very, very low unsold inventory index, and we have very low median days on market. So this is showing that we have basically a very short supply of housing. I expect that it'll take a year to a year and a half for us to get back to normalcy. So even though we have some decline in velocity, as you can see here, 10% year over year, the housing is so short in supply right now, and our days on market is so short that it'll take a while for that inventory to be back up into normal areas. So for the most part, even though we're seeing some declines, I think the housing market is relatively healthy here for at least the next year and a half or so. Bay Area here out here in California had the biggest decline of all regions. You can see over there to the far right, we are actually heading into less sales in the Bay Area. This is also relatively consistent across the nation, as well as other parts of California. We'll also see here, January 22, home sales growth by region. You can see this. This is more California based, but this is also relatively consistent even throughout some of the South, the Texas, your Georgia, and your Arizona, that area as well. We will see here that, January of 22, which is just here a month or two ago, that we do have decreases in home sales growth. 4 to 20%. It is starting to slow at this point. Share of $1 million homes declined at the most in 11 months. So that's an area that Zinc Income Fund does not particularly focus on. $1 million homes are above the median cost of housing. They are the largest group to have the most stress, because obviously most people don't want those homes and they can't afford them. So we're starting to see some decline in that alternate asset class as well. Pending sales are continuing to decline as well. You can see from this graph that it's been very strong from, say, April of last year up to July. It was sales were above industry average. We are now starting to see a dip in pending sales as of January, down 16% year over year. And so again, I kind of view this as good. We have got to get some relief on this appreciation that is simply unsustainable. Is this a drop off of a cliff type of analytic? No, it's not. I'm actually view this as a positive sign that we're going to get our appreciation back in check and get down to some normalcy. This will continue to go this way with the anticipated rate increases that the federal government is indicated that they intend to proceed with over the next year. California median home price declined as well. It's the lowest since March of 2021. We're seeing that come down a little bit as well. We're also seeing that in the rest of the nation as well. I think this is good, again, as we start to see more normalcy in housing. I've talked about that previously. Our average appreciation over the last, call it 80 years, has been 2.5 to 3%, 3.5. Mapping the consumer price index, we obviously have been excessive of that over the last few years. That is simply unsustainable. So the fact that the median home price has declined to the lowest level in about a year, I think is a positive sign that we're moving more towards normalcy. Our fund protects its investors by staying below the median cost of housing for loans on distressed assets. This next graph, I think this is an important time to talk about something that I do specifically here at Zinc Income Fund. One of the things I do, and I think this is a very, very important segment to talk about, is I pull the data from our federal government on loan monitoring and portfolio performance. The federal government tracks 71% of the nation's loan portfolio through call centers and loan volume. And so they track this data and they track the calls that are coming in and what are those calls for. So what I do is I actually purchase and secure this data from the federal government. And then I start mapping out what the call volume is. And here's what I'm looking for. I look for forbearance requests, foreclosure avoidance. I can't make my payment. It's very important to the callers or the attendees on this webinar. It's important to know where the housing is today, but it's more important to know where the housing is going. One of the first indicators that I look at for housing performance and where it's going is, are people calling in to the servicing agent of the loan? Are people calling in saying, I can't make my payment, or I need a forbearance, or foreclosure avoidance, or whatever the situation is? That's the first indication to me that housing may be dipping here in the near future. The first thing that happens when the housing starts to dip is people start calling the servicing agent and saying, I can't make my payment. So I take this data from the government and then I chart it and I graph it and I study it. That way I, as the manager of the Zinc Income Fund, can start to project out where housing is going from a default perspective. Obviously, when we have defaults, the next thing that happens is we have, price depreciation. So I'm on the front ends of this. The average person does not have access to this data and they can't get this data, but I do. We get it and we chart it. So this first graph here that I look at is the percent of current mortgages. Again, the federal government tracks about 71% of the nation's mortgages through the call center volume. This current graph, or current chart rather, shows the percent of loans that are current. You'll notice on the West Coast, it's very, very current. California, Nevada, and Arizona, and even through the Texas and the Florida and that corridor down there is still relatively solid. But up in the Northeast, you'll see some stress. It's more of the purple. We have more people up there that are obviously constricting and have the inability. They're placing more calls for help with their servicing agent. But for the most part, this graph is relatively healthy. And I'm going to show you over the next few slides how important this data is. If you are on this call and you are looking to put your IRA or your other cash funds into alternative investments, one of the things you need to be mindful of is placing that with an operator that is very, very intelligent on that asset class and where that asset class is going. Obviously, with us doing nearly $1 billion of this over our history, we want to make sure that we can adequately chart where these trends are going. So percent of, this is a very important analytic that I look at. Percent of servicing portfolio in forbearance. And what's important here is we're at about 1.3%. That's exceptionally low. So for the most part, people are not calling their servicing agent saying, I cannot make my payment, a foreclosure avoidance or whatever. I take this data, I put it in this graph. You can see right here that 1.3% of the calls are simply in some form of forbearance. Another way to look at this is 99% of the loans out there across the nation are performing adequately. Why? Well, as I mentioned previously, most of these loans are full doc loans, 30-year amortized loans by Fannie, Freddie, USDA, government-backed loans. And so with that, we have full doc loans out there. We do not have the loan product back in 2005 of option arm, interest only, et cetera. These are fully documented loans. So one of my pieces of advice here is that we have a 99% performance on these loans with a lot of equity. And so that is good news. Even though we have some housing that is starting to dip in velocity, existing housing from a portfolio performance standpoint is performing very, very well. We only have 1.3% of the nation's current housing where it's in some form of forbearance. Here is another graph that we've put together here, a servicing portfolio that's in forbearance by investor type over time. But at the end of the day here, you can see that, in 20, we were actually at, back in the pandemic, very important here, back in the pandemic, boy, we had 5 to 15% in some element of forbearance. People were at home, they couldn't work, and boy, who knows where things were going. You can see today, it's no longer 5 to 15% in some element of forbearance. We're down there at 0.6 to 3, about 1.5%. So we went from a 5 to 10 in forbearance or housing stress down to 1.5. It's a very strong portfolio metric that basically these loans are performing. Monthly borrower forbearance and re-entries. In other words, somebody was in forbearance and they're re-entering forbearance, or they're re-entering a stress point with the service provider. You can see it's exceptionally low, 0.08, 0.3, 0.2. Very few people right now are re-entering. In other words, they're leaving forbearance or they're leaving foreclosure through the servicing agent. They're simply not re-entering right now. So I'd like to open it up for questions and answers. I am Todd Piggott. I am the president and managing member of the Zinc Income Fund. We're located out here in California. We're across the nation. We focus on alternative assets. We loan money to investors who purchase distressed properties, and then they rehabilitate them and then sell them on the open market. And so, we charge our borrowers, 9.5 to 10%. And then of course, 8% rolls to our fund after costs and servicing fees. And that 8% is obviously rolls to our investors. We have a lot of, over half of our investors are IRAs. People put their retirement money in there and they earn 8% consistently every single month. We have a mortgage debt fund. And so that mortgage debt fund provides loans on distressed properties below the median cost of housing across the nation, where investors, buy them and fix them up and then resell them. Our delinquency rate is probably about 1%, about 1.2%. So we have basically a very stable and sustaining portfolio of loans, 99.5% performing portfolio. These loans are made against housing that are in need of rehabilitation so they can get a conventional loan. And so that's why we study these metrics and these graphs. Where is housing going? Where has it been, and what can we expect? Here is the overall theme today. Housing portfolio performance is very strong by the federal government that tracks this. I pull about a 75-page analytic report for call center volume. It's strong. Loans are performing. Housing is starting to show some signs of stress. I actually view this as positive. No longer will we see the 10 to 12% appreciation. We're probably going to get back to normalcy there. We might, in the next 18 months, have a dip in appreciation or have some form of depreciation, but I don't expect it to be the cliff that we had in 05 and 06. I will say this. If we do head into a recession for housing, I expect it to be some other calamity outside of the actual housing market. So if housing does head into recessionary pressures anytime soon, I think it's going to be something else that caused that, not necessarily the industry itself. We have a lot of unknowns out there with the pandemic, war, interest rates, and political uncertainty. I believe that if there is something that occurs in housing, it'll be some other type of event that will cause that, not actually housing itself. Because as you can see from these graphs and analytics that I put up here today, for the most part, we're in a relatively healthy market right now. So with that said, you can see if you have any questions, you can certainly give us a call here at the number there on the screen, 559-326-2509, or you can reach me by email at todd.p@zinc.net. And of course, you can always visit us at zincinvesting.com if you have some questions as well. We do have a couple of Q&As. I'd like to go ahead and get to these and answer these for you. Is this how I do this? Well,
go ahead. I was just going to read them off for you. I didn't know if you had access to it, but the first one is, will we get to see a replay? And the answer is yes. This will be available on our YouTube channel by tomorrow. So if you're looking to rewatch this video, so soak up all the information, it'll be available for you pretty soon. Next question is, how long is the loan? I'll let you take that one away, Todd.
Sure, that's actually a great question. And we have a question here from an attendee on here. How long is the loan that we do? I think this is actually a really important question. Our loans are about 12 months, and I designed our fund for this reason. We're a short-term bridge lender. We make short-term loans to investors who buy distressed housing at a very low point, rehabilitate them, and then resell them on the open market. And the reason I like short-term bridge loans is no matter where we're at in any real estate cycle, we're in and out of the loan product in less than 12 months. So whether there's appreciation or depreciation, I am minimizing the risk to my investors or my IRA investors by being in short-term loan product. did this for a reason, and I designed our fund for a reason. The question is, how long is the loan? Our loans are 12 months. We do that by design. That way, if we are in depressionary or appreciation, climates, it doesn't matter because we're in and out of the loan product so quick. Our borrowers put down 10 to 15% in cold hard cash. We do an LTV against the purchase price of 80 to 90. To be very candid with you, if the housing market depreciates, 10 to 20% in a 12-month period, we're in a whole nother world of problems across our country. So we're relatively insulated from recessionary or even appreciationary factors because our loan product is so short. These investors are in and out in a period of about 9 months, even though it's a 12-month term. And so we've mitigated that risk by being out. Our values are constantly being refreshed throughout our portfolio because the loan product is constantly churning. That was a great question. How long is the loan? So I'd like to go ahead, open it up and see if we have any additional closing questions. Right, Bill?
Yes. So another question is, with all of the variables in play right now, what is the importance of the trends in the housing market over time?
The trends in the housing market over time, I think, are relatively solid. We have a shortage of housing, and we have a shortage of multifamily right now. You can see from these graphs that we have about a 1 to 2 month supply. I expect that to be foreseeable probably up through 2025. The interest rates are going to increase. That is going to put compression on housing appreciation. But for the most part, housing below the median cost, which is where we focus on our alternative investments, is relatively healthy for now up into the foreseeable future. I am relatively confident that housing, because of low inventory and still historically low rates and low days on market, is extremely safe for us up through 2025. Past that, I don't have that crystal ball, but for the most part, we are in a very, very healthy phase right now, even though there's some velocity holdback here. For the most part, over the long term, I look for housing to be a relatively safe investment. I have my IRA in it. I have my savings in it. That's where I put it. At the end of the day, entry-level housing is something that is needed, and it's very needed right now. It is in very short supply. As interest rates increase, do you expect your return to increase too? That's a fantastic question. Yes. Now, our rates to our borrowers are not tied by the Fed window or prime, because obviously we have private money. Private meaning high net worth individuals or people with their IRAs put their money into our fund, and they earn about 8%. And all of that money is secured. I think it's very, very important. That is a secured investment. We have a first trust deed, first lien position on all of our equity that's out there. So, but interest rates for us, we do expect them to climb slightly, but we are not tied to prime. Mortgage rates for the consumer are directly tied to the Fed window. So when they increase rates, mortgage rates instantly go up that very same day. For us, it doesn't work like that because our money is tied to IRAs as well as high net worth individuals that invest in our fund. So our rates don't go up at exactly the same time that prime or the Fed window increases rates, but naturally speaking, our rates would obviously increase as well, just not as closely as the Fed window. So I think that was a very, very good question. I'd like to see if we have some more questions to answer. They're all great. Bill, do we have any more coming through?
Yeah, so the last question we have here are there any qualifications that IRA holders should be looking out for in order to get the loan or start moving forward with their investments?
Well, I think for us, we have over 50 to 60% of our capital in our fund, which again produces historical rates of about 8% net to the investor, is IRA money. I think what's important, to be very candid with you from an IRA perspective, is that you whether it's us or somebody else, is that you are putting your capital, which is very, very hard to get. Look, all of our investors worked very hard. Nobody hit the lottery. Nobody inherited it. Believe it or not, all of our investors worked very, very hard for their money and they saved it. So I think what's very important is that people with an IRA or a high net worth individual that saved money, that they're placing it in an alternative asset that has security interest. I'm not a big fan of placing my hard-earned IRA money into speculative investments or high growth investments or things like this that are very susceptible to what I call irrational exuberance out there. It's real simple. I want my IRA money, which is where I'm at. I'm in the Zinc Income Fund, to be in in an asset class that has a secured interest. We have a secured first lien position interest with the underlying collateral. So at the end of the day, we either get our 8% return or we're going to get a nice rental home. That's it. There's no way for us to have either anything outside of those two items. So for an IRA holder, I think it's very important for people to look at alternative investments that have a perfected secured lien. I don't want to invest in partnerships or other lofty type of projectionary types of investments. I don't like those. They're too speculative. I would rather have a safer investment where I have protection of principal, which is what we focus on. Protection of principal, a secured lien against a housing unit that's below the median cost of housing. I think that's one thing that's very important for IRA people, including myself, to look at. At the end of the day, I want to make sure my principal is protected more so than the rate. What is the minimum investment amount? Our minimum investment amount here at Zinc Income is $100,000. We do have a preferred rate of return for those that invest over 500. So we have a minimum of 100,000. Our average investor here, 300,000 or 400,000, but our minimum is 100,000. And our historical rate of return is 8%. And again, that has it's secured by the liens against housing below the median cost of housing. So it's worked very, very well for me over the last 20 years and my family, as well as a lot of our investors.
I think that about sums us up, Todd. So I want to thank you for your time, your expertise. I really do appreciate you coming on and giving the people the knowledge that they need to know.
Thank you very much. You guys have a fantastic day, and thank you for having me here. All is well. Have a great rest of your week.
Of course, you be safe out there, Todd.
Bye-bye.
Take it easy. And following finalizing today's webinar, we are going to give you guys a promo. It is spring 22. Anybody who's opening up 2 or more accounts with NuView today, again, that's spring 22, you can contact our IRA specialist at iraspecialist@NuViewTrust.com. And if you need anything else, you can follow us on Facebook, Instagram, YouTube, LinkedIn. We have plenty of information out there for you guys. That about sums us up for the day. If anybody has any questions, feel free to reach on out and get you some help. Take it easy. Thanks. Bye.